Welcome to the webinar, Banks Unleashed, the new era of growth, M&A, and regulatory reset, hosted by John Winnick, Clark Street Capital. John, I believe this is our first webinar of the year. You had a very successful run last year, great topics, great panel. Josh Siegel, Stone Castle, Paul O'Connor, Anchor Strategic, Michael Mincuzzi, Arnold, and Porter. Gentlemen, welcome all. Let me do a couple of housekeeping things first. All-star panel, they can answer all your questions. Just use the chat feature and we will get that to them. And John, I'm going to stop talking. They don't want to hear me. They want to hear from you. John Winnick, Clark Street Capital. What are we talking about today, John?
Yeah, I'm going to start with a quick overview. This is hot off the press, so apologize. This is from Bloomberg, but we'll touch on credit very quickly. I mean, the main story in credit to be concerned about is the consumer. The Federal Reserve Bank of New York does a household credit survey. The Q4 data just came out, and we're now at the highest delinquency rate on consumer loans since 2017. It spiked from 4.5 to 4.8 in the fourth quarter. So a little bit of concern about it. If you go to the next slide, that report breaks it down by 4 areas. The big one this year is student loan delinquencies. They were artificially low because collection had ceased during COVID. That's resumed, and you could see the spike there. Credit card delinquencies are going up. Probably not the best time to talk about a 10% interest rate cap on credit cards when delinquencies are rising. But you could see, not necessarily things to be alarmed about here, but you're definitely seeing an uptick in a few areas, and the trend is fairly consistent. Let's go to the next slide. And I appreciate this came from KBW, Stifel. This was at the Acquire Be Acquired conference. I did steal 2 of their slides, which I thought were really good. Overall, bank fundamentals improving across the board. You could see growth has returned this year. Net interest income, earnings per share, double digits for 2025, 2026, close to there in 2027. Profitability is better. You could see efficiency ratios dropping across the board. Credit quality is stable. So overall, if you go to the next slide, I think this outlined it fairly well, all the changes with the new administration with respect to regulatory relief. At this point, and we'll get into the Fed in a minute, the Trump administration has essentially replaced, or will soon be replacing, everybody across the board. Obviously, new FDIC chairs, Mickey Bowman, vice chair of supervision at the Fed, new controller of the currency. And a big takeaway is it's just going to be easier for banks to do deals, and regulatory burden is lessening across the board. As we switch to M&A on the next slide, there's been a dramatic reduction in the time for mergers to be approved. You could kind of see timelines were 227, 219 days during the Biden administration, and the days to close have come down considerably. You're seeing as little as 70 days now between the announcement of a merger and a closer. Why is that important? Michael or Josh or Paul, why is a shorter timeline for M&A important for acquirers?
Well, I think what we're seeing now is that there is an appetite for M&A deals, especially on the larger side of the industry, where the regulators generally weren't open for business on their combinations for the last few years, especially in the Biden administration. So I think what we're seeing is there's a window of opportunity, and it's hard to say how long that window will last, even though Trump has what three more years in the presidency. But the M&A window may be a little shorter than his tenure.
Yeah. If you go to the next slide, just a dizzying array of deals have been announced. This is just since really October, and we'll get into the Santander deal in a second. But every time you turn around, oh, did you hear? We're up for sale or being acquired by so and so. So this is happening very fast and furious. You can see all the deals that have happened since the second half of last year. The latest deal on the next slide is Santander, and these are two slides in their presentation, is acquiring Webster Bank. Josh, you have some thoughts on Webster Santander. Why don't you give us a little commentary on that?
Sure. I mean, I think what's interesting about this transaction is while Santander did have a U.S. presence, it didn't have that, what I would call a parochial presence, right? Local community, sort of an understanding of the local market, viewed by the local market as a local bank. Webster's changed over the years from sort of its Connecticut roots and the Sterling merger several years ago, but they maintained a market position and reputation as a large local bank. And then with the introduction of the Sterling team, became a very forward-thinking organization without losing that connection. So they really embarked upon a number of different strategies to dramatically reduce the cost of deposit acquisition, which fueled very cost-efficient growth. I would have to guess, without knowing, that was probably one of the driving factors of why the acquirer was interested. But I think it allows Santander to take a very different position in the U.S. with a very local brand and a very trusted New England name.
Paul, your thoughts?
Yeah, I think it's a deal that makes a lot of sense. I mean, they increased their U.S. assets by 50% to $252 billion, makes them a mid-sized bank in this world. It increases their loan book 45% and deposit 67%. I think the one thing that people really haven't talked a lot about is, they paid a little over 2 times tangible book value, 12.81 times earnings, which sounds like a huge price. And then you kind of look at Banco Santander. They currently trade at 187% of tangible book and 13.64. So the mix of cash and stock, the ability to get a tangible book value payback period that's pretty low, pretty significant EPS growth for the combined companies. It makes it look like a really good deal. And when you're trading at a high multiple, you can pay a high multiple. It kind of works out in the end to do that. I think the one aspect I'd say, it was sort of an unexpected buyer. It's their first deal in the U.S. since 2009 when they bought Sovereign Bancorp. So ironically, in looking over all the analyst comments and other things, in preparation for this, biggest criticism I saw of the deal was that the stock premium paid was only 15% versus the average of 22%. So I got to say, if you're Banco Santander CEO, you got to be feeling pretty good about yourself so far.
Yeah. You go to the next slide, just a couple other, you could see an opportunity to really compete against the PNCs and the U.S. banks of the world. I think, am I correct, Josh? I don't know it seems like every other European bank is divesting out of the U.S. I mean, they seem to be, this is against the trend, huh?
Well, it is against the trend. But what's the old adage? When people run out of the building, valuables are left behind. I think they're seeing the counterpoint of the U.S. market isn't going away. And while there is a very anti-U.S. sentiment, obviously, with what's going on in Europe, with walking away from Microsoft, Apple, Google, they're taking a different tact. So I'd say smart on them, but we'll all see how it plays out in the coming months and years.
Yeah, one of the concerns, John, that kept coming up was whether the Trump administration was going to get involved in the approval of this deal.
Yeah. Well, so far, I mean, there hasn't even been, I don't think a single merger it's been a pause. I mean, anything's really been vetted or issues have come up. It just seems like these are all sailing through now.
Well, I guess I would make one additional comment to what Josh had talked about. None of these guys are unknown quantities. They've all been serial acquirers. They all trade at huge multiples. They've got tons of capital. I mean, when you look at how much time the regulators are spending on this, you kind of have to ask the question is, why? I mean, they probably could look at this thing in 24 hours and go, yeah, it looks like a good deal to me. Let's approve it. So I think the time frames will be more important when the $500 million bank buys the $200 million bank, or a group of, former bank, CEOs buy a bank and want to get started again. That kind of, smaller deals, lesser known players. That's where I guess I'm going to be interested to see how the regulators react.
Yeah. Well, I think that time frame is important because during a period of a merger, everything just freezes. And if it takes a year to get a deal done, you lose your wealth management team goes to somewhere else, and this team leaves, and it just creates kind of a pause at both banks until the deal's completed.
I think it also trained the market to have pre-deal fatigue. Like nobody wanted to embark upon it because it was so arduous. Now that they're seeing deals can actually get done in a reasonable timeline, I think that's actually going to spur more active discussions on M&A.
Yeah.
Mike, are you telling your clients 60 to 90 days for approvals? Is that the guidance you're giving?
That's what it's been lately. It wasn't very long ago that it was 6 to 18, sometimes even 24 months to approval. And now we're seeing approvals in 30 to 60 days. So, certainly, like I said before, the window is open. The opportunity is there. The regulators are welcome these transactions, and I think because of that, we're seeing a flood of transactions.
Yeah. Switching over to another important topic, a lot of these deals are being driven. Well, some of them are being driven by activist investors. Holdco's a good example of that. Ironically, yesterday, Holdco completely backed down on KeyCorp and Eastern Bank shares. No longer interested in pursuing an activist fight there. So maybe they're just choosing their battles. But what do you all think of the rise of activist investor? Josh, I know you have some thoughts on that.
Yeah, I mean, look, obviously been an investor in banks for, nearly 30 years. Banks tend not to change their approach to the world, even though mentally they know, I need to find a way to generate more non-interest income. I need to find a way to cut expenses, or I need to be considering new products for my customers. Yes, we all understand this, but the reality of inertia, even at a mid-sized bank, nevertheless a regional or a money center, is they just can't really change the culture very easily. It's just too easy to do tomorrow what you did yesterday. And so I think not all activist investors, but reasonable activist investors are going to be the agents of change. They're showing that they can force a board or management to have to take an action. Doesn't mean that the activist is always right, but there's a difference between not acting and not acting after having serious internal discussions, reviews, board meetings. You can still get to the same answer, but you have to force yourself to challenge all the assumptions that you take and do every day, right? That's how we do business. Why? Why don't you do it differently? Why don't you reconsider? So I think activists at the moment are actually not necessarily the worst thing. And I think that there will be more of them going forward.
And that's a good point, Josh. And I think what we're seeing is a lot of the activists are trying to catch the wave of heightened valuations. And when you look at over the last year, this was probably one of the in recent times one of the most active years for investor activism. And we see that they are looking at changing management or changing the board, looking to cause the institution to sell, or questioning the way the institution employs capital, or like Josh said, operational inefficiencies. But I think all of that is because, again, there is this wave of transactions. The regulators are open to it. Valuations are pretty high right now. And so I think it makes sense to see this kind of level of activism. So I think it's something that we'll probably continue to see through 2026.
John, I think there's also some pretty easy pickings out there. I mean, Comerica, their stock price, I don't think it increased in 15 years.
Yeah.
I mean, and a lot of these guys up until recently, even I think pretty well-performing banks haven't really seen their stock price perform very well. So, there's sort of that we're doing okay, but we're not doing great. And then there's sort of the guys that have had financial problems and haven't fixed it quickly enough, I think, in the eyes of some of these activist shareholders.
Yeah. Well, and the whole thing seems fairly predictable. It's rinse and repeat. Such and such bank isn't maximizing value. They're undervalued. They need to sell. So and so should buy them, and then they push them to announce the deal, and then they're out in 6 to 18 months. It seems fairly predictable how this plays out.
I think Josh will agree with me. Dealing with them is about as much fun as getting a disease.
There are other analogies, but that one works too.
Yes. Yeah. Sorry. I'm open to suggestions.
Switching over to bank earnings. It's interesting when the largest banks came out with earnings, the largest 4 banks all disappointed. I think as you dug into the regionals, everybody else, overall bank earnings were good. Josh, we talked about this. What was your take on bank earnings and why maybe the large banks weren't doing as great?
Well, the key words were the 4 largest.
Yeah.
When you get to the size of being $1, $2, $3, $4 trillion, it's very hard to find enough customers who are of a size that you can focus on. And just by the nature of the distribution of size, most customers, whether deposit or lending customers, are becoming too small for these large banks to address. And so they're not going to be able to be tactical. They are the market, right? And so they are going to move like the oceans. They can't. I mean, a friend of mine who used to be a portfolio manager at BlackRock said, I can't be tactical, right? My position size is $300 million. I am the market, right? He ran a large loan book over there. And I think it's the same issue for the largest banks. And if you look at data, and I'm a huge fan of data, once you get past a few $100 billion of assets, which that used to be the size of the largest banks in this country and not a long time ago, that's about as efficient as you get. The numbers prove that out. You tend to become less efficient over that size. And so someone might like to say otherwise, but the data doesn't lie. So I'm not surprised. And I don't think that's going to change, John. I think we're going to see the largest banks continue to underperform, especially if we take out the markets component, because that's not banking, right? That's capital markets activities. That's very different. Traditional banking, it's going to be very difficult for the largest banks to find ways to outperform, and in fact, will tend to underperform.
Paul, what's your take on earnings?
I agree with everything Josh said. I think, I remember my unfortunate 2 years at Bank of America. We used to describe it as an aircraft carrier turning around in a small lake. It just took a lot of time, and you had to be exceedingly careful to do anything. Nobody made a decision. The top to bottom, you might have 25 layers of management And that was when they were $250 billion, let alone, 3 trillion as they are today. I think the other thing is that a lot of these guys are really focused. I think, as Josh said, it's capital markets activity, it's M&A, it's sales and trading, which is very inconsistent generally. So it's hard to get your stock price moving based upon those earnings. But yet that's really how the CEOs get paid. So you can kind of look at where the pay aspect is versus where the stock price is. And I think operating a normal bank just is too hard to do and doesn't pay well enough.
But John, let's flip it to the other side, though. Rather than just pounding on the big guys, I think there are some natural trends that are helping the small guys. And that, yes, delinquencies are picking up, but loan losses haven't really materialized in major ways yet. The underwater loans in terms of the price, right? Older fixed rate loans, they're naturally maturing off. And so time and growth tends to improve net interest margins. Deposit costs are coming down, right? As the Fed has backed off a bit. So there are some macro trends that naturally are helping your average bank. So I think the ones not encumbered by their size are going to at least see, probably still for another quarter or two, likely improving financials just through the nature of growing out of it and the prepayment or just pay off of existing fixed rate loans or low spread loans.
Yeah. Well, Michael, are you, to Josh's point, are you hearing that the regulators aren't as focused on liquidity anymore, that, we're a few years away from the SVP thing and it's kind of in the rearview mirror?
I would say it's not that they're not focused on it, but or they don't have the same focus on it, I think would be accurate. We've heard from all of the heads of states of the banking agencies that their focus is on key financial risks to the bank, to the institutions. And so, we're seeing that shift in the supervisory process as well. We're seeing that MRAs are dropping considerably. It's not that the examiners aren't taking a look at things, but the hurdle these days of what makes an MRA is quite high. And so what you're going to see, what institutions should be looking at, really are the observations that are now popping up in examination reports. That's really what used to be the MRAs. So, boards shouldn't take their eye off the ball when they see observations in an exam report. They ought to be giving that the same level of attention that they in the past were given MRAs. The label doesn't matter in terms of a supervisory issue. It may matter from a enforcement perspective. There may be an additional step to take before we see the enforcement uptick, but boards of directors and senior management shouldn't be complacent because what they see is observations as opposed to violations or MRAs.
Sorry, MRA stands for our
Oh, I'm
group.
sorry, matters requiring attention.
That's what I thought. But great. Go ahead, Paul.
I agree with Michael. I think, and I go back to the old days, we used to tell them where they made mistakes and suggest they be corrected in the next 6 to 12 months before we get there. If they're not corrected, then usually there was hell to pay. You've been warned, given an opportunity, fix it, now get on with life. I think my concern, and I don't hear this very often, but it seems like with the Doge effect on these regulatory agencies, you've got a lot of 50, 60-year-old guys who've just retired and they were being replaced by 25-year-olds. Now, I think I was an amazing examiner at 25, but it's kind of young. You don't have a lot of perspective. And I think you need that senior, we've been here, this is important, this isn't important. And I think that's been lightened up. And now the Fed is talking about cutting the board staff by 35 to 40%. I think this is going to mean that the regional Federal Reserve banks are going to have to step up and play a bigger role than they have in maybe the last 10 or 15 years.
Yeah. We're also going to see the states stepping up into supervision as well.
Yeah. If they can.
Obvious states like New York, for example, their examinations are becoming tougher and tougher as opposed to what we're seeing at the federal level. So I think, yes, you're right. But this comes in waves. The federal banking agencies have gone through downsizings before, and we've seen this same type of impact on sort of middle management, I guess I'll call it. But what ends up happening is if there's a crisis or something, what we've seen is a lot of those same individuals come back to the agency on a contract basis, usually for a much higher salary than they were making when they retired. So, I think there is precedent for the agencies to deal with this type of manpower change. But I think, that doesn't mean that all of that institutional knowledge will be gone. It just may come back under a different cover.
And I would just ask you to look at 2007, and then when they were trying to figure out what a bridge bank was in 2009, even though the late 1980s and 1990s had plenty of them. They had no institutional knowledge, and the catch up was probably cost hundreds of billions of dollars. Yeah. That's I guess these guys don't make that much money to keep them around just to say, don't do this, don't do that, or I've seen this before, go look at this. And every time we seem to cut $250,000, we lose $25 million.
That's the cycle, right? I mean,
yeah,
you go to the 70s, right? You had a very regulated system. Reagan comes in, deregulate, savings and loan crisis, followed by the FDIC Improvement Act, Berea. It's just, this is the cycle. And I don't think this time's any different, right? So all of these folks are going to have trial by fire, and they're going to learn. And then there'll be the 30, 40-year-olds. The banking system will still exist, but it'll be different. And that's the nature of the beast.
Yeah.
So you're telling me I should still hold off on my return to the Federal Reserve? I still have my IOU outstanding.
We need you, Paul. We may need you. I don't think we can pay you enough, though.
Yeah.
All right. So we got a poll question. Got a poll question. How has regulation changed under the new administration? Bankers only. And we asked this question before. Significantly less regulation, moderately less, no change, slightly more. Bankers only, please.
Maybe the better phrasing of that, John, right, is not how regulation, but how is enforcement, right?
Yeah. That's true. They're coming in, but I mean, one person said slightly more. I'd love to talk to them. But consensus seems to be 2/3 are basically saying moderately less. 13% significantly less. We can close the poll question now. Michael, what would you say? Moderately less, significantly less, no change? More?
I think supervision is similar. I think it's enforcement that's changing. We had talked earlier about what it takes for something to be cited as a matter requiring attention in an exam report, which usually is what triggers the enforcement discussion. So what I think we're going to see is less enforcement, formal enforcement action in the short term. But as these observations in the exam reports, not that they get ignored, but they may not be addressed because you don't have the same, focus as you may have for an MRA or matter requiring attention in an exam report. As those issues don't get fixed, I think things are going to step up. The one caveat here is the one area where you continue to see violations of law, matters requiring attention, relate to the Bank Secrecy Act compliance as well as economic sanctions compliance. And it's clear that this administration is heavily focused on those issues, especially on the BSA side when you're talking about transnational criminal organizations, terrorism, narcotics trafficking. Those will always be a focus of the administration and correspondingly a focus of the examination staff at the bank regulatory agencies. And OFAC's enforcement will continue to see those actions because of the way this administration uses its powers under IEPA, the Emergency Economic Powers Act. And that's
BSA,
how,
so BSA, that category doesn't seem to change from administration to administration.
it doesn't change in that there will always be enforcement activity there. What changes is the focus. What generates that the enforcement activity, and what we're seeing here is, they're looking for narcotics trafficking activity and terrorist financing and transnational criminal organizations' use of the U.S. financial system. For example, Chinese money launderers using narcotics traffickers in the United States to launder their funds. You see a lot of guidance out there from FinCEN and the banking agencies on these types of methodologies. That's a key focus of the Trump administration, both on the administrative side as well as the focus from the Department of Justice on those issues as well.
Yeah, but hey, I want to call out an unfair thing that maybe it's obvious. We talk about that and it is reasonably true that administration agnostic. There's a lot of crackdown on BSA, OFAC-CIP. But it's only on banks, it seems, because there's no problem in the brokerage world with Tether taking foreign money from a lot of criminals, going through an unnamed, clearing broker and putting those dollars in, and yet those same people could never get accounts at a bank. So how is it that the administration's fine with it going through the 40 Act, but anything has to do with the Bank Act, whether it's the National Bank Act or any of that, it gets trapped on only one side of the fence? I find that to be absurd, by the way.
Yeah.
I think that just highlights the historical, trends in enforcement under the BSA. The SEC and FINRA have always had the authority to enforce, but they typically have lagged the banking agencies in their enforcement. And I would say correspondingly, the DOJ doesn't spend as much attention looking at that activity as it does in the banking industry. So I think you're right, and I think smart people that look to take advantage of the U.S. financial system have seen that as well. And I think that's why a lot of the activity does go not undetected, but maybe unpoliced.
Yeah. Paul, last
I can't wait for that first crypto bank to be able to know their customer.
Yeah. Paul, significantly less regulation, moderately less, no change. The new administration.
I've kind of heard two different versions. There's the guy who's getting the CRA people all over him because of his mortgage underwriting. And it's a bunch of, 25-year-old, 30-year-old people who that's what they really know. So it's hard to argue against them. And then I think generally a little bit back to that time I was talking about, when we would do a bank examination, we kind of tell them where their problems were, but it was, I'll call it a gentleman's agreement. You fix it, we won't comment on it. You don't fix it, we come down very hard. And I think it's gone back a little bit more to that style than it used to be the MRAs for, 5 people didn't, calculate this, or the teller didn't stay up until 5 o'clock. A lot of it was just BS stuff that I'm not quite sure why they were doing.
Yeah. Let's talk about Kevin Warsh, President Trump's nominee to be the new Fed chair. I know you have an opinion on this, Josh. Please share it.
Yeah, it may be counterintuitive. I haven't been a fan of a lot of this Trump administration's picks in certain roles. I was surprised to see Kevin picked, but not for a bad reason. Kevin's a professional, and he's a hawk. And I think that despite all of the public persona, I think Kevin's going to do what he thinks is best from a classical Alan Greenspan Fed perspective. And I don't think Trump's going to ultimately be very happy with that. But I think having an adult, although he's one of the younger that we will have ever seen in that seat, I think he's going to be the first adult in the room in a while, and is going to take a very academic, a very market-oriented view. And I would put my nickel down a lot less political than the administration's hoping.
Michael, Paul, any thoughts on Kevin?
Michael, you're the DC guy. You got the scuttlebutt.
I don't have the scuttlebutt on this one. I thought it was I would call it a strange choice, but I was surprised by it.
Yeah. So kind of getting back to your earlier point, I mean, is the pretty much everyone, the new administration's pretty much picked new people for every role. Is there anything left now that the Fed chair has been picked? Michael, sounds like it's been a
Yeah,
complete.
I think all the new heads of states will be in place once Mr. Walsh is confirmed as the chair of the Federal Reserve. But I think just about everyone else has been taken care of. The only agency that really is in a lot of flux is the CFPB, and I think that will continue depending on how the ongoing litigation goes and what we see out of the Trump administration on that front.
Let's stay on that for a minute. CFPB. What's the latest? I haven't heard anything on it in a while. You kind of said that states were kind of stepping up some enforcement. Why don't you give us an update on the CFPB and consumer regulation, Michael?
So I'll say your traditional blocking and tackling as far as consumer protection goes, the mantle has been picked up by the states. So we see a lot of the states that have picked up their activity, like New York, California. Those shouldn't surprise anyone. Florida has as well. And so we're seeing this shift over to the states. Interestingly, though, the CFPB just announced recently that it has reopened a number of investigations that they had put on ice when the administration changed, and that they were also, looking at taking some enforcement actions on some of those cases. And I think what's going on there, and this is just my own personal view here, is the administration is coming up, is going to have to present to the courts the various things that it's doing, and what one of the things that it has to do on the in the CFPB legislation is show that they are meeting their statutory mandate in protecting consumers. And I think a number of these actions around the edges that the CFPB is doing is so that is window dressing, so they can try and meet that standard with the court. So we'll see a little bit of activity at the CFPB level, but not very much. I think in the short term and perhaps even the long term, if the cases continue to be mired in the court system.
Basel III, another thing we haven't heard about in a while.
So
what's the latest on that?
The Basel III endgame is coming. It's the Federal Reserve and the other banking agencies are working very hard to finally put that to bed. I think it's we heard at a meeting earlier in January that it's one of the top priorities for the Federal Reserve Board to get the Basel III endgame done. And so I think we're going to see that, if not, the end of the first quarter, but maybe definitely within the second quarter, we'll see a new proposal. Expectations are it's going to be much more capital neutral. I think institutions feel like they have excess capital because of the buffers they have been required to put on the books over the last few years. So I think we'll see something maybe in the first half of the year, a new proposal on the Basel III endgame.
Yeah. Well, I know there was a vote last night, Josh, when we had our call. There was a bunch of changes that the House was passing.
Yes.
Can you give us some color on how that related to banks and community banks in particular?
Sure. It was HR 6644, Housing for the 21st Century. Originally passed the Senate, came to the House. The House added a whole section 600 and, different subsections that really were tied into what was also in a different act that hasn't yet come to the floor called the Main Street Capital Access Act. and it's generally trying to reduce the burden on community banks from regulatory cycles to funding to what's defined as a large or small organization. That passed overwhelmingly. I think it was 390 to 9, which is in this House is kind of shocking in a positive way, to have that much bipartisan support. So that will change and increase the amount of reciprocal deposits, custodial deposits, exam cycles, and a number of other things. But now it goes back to the Senate on this modified version. I think it's going to be a tall order for the Senate to push against it, given that if you go through the sections in there, you could obviously have a debate whether that's going to fix housing for the 21st century. I mean, some will, some won't. But it definitely allows smaller banks to get more involved in banking again in an easier way, reducing the burden and the pain on those organizations. So, Elizabeth Warren is usually the most difficult, but she's on record after the financial crisis saying community banks weren't responsible for the financial crisis, which they weren't. So it'll be hard to push back against this because I don't see anything in there that benefits regional or money center banks. It really is geared on smaller institutions.
Michael?
Yeah, the one thing I would say about that is, the way this came to fruition, the housing bill started in the Senate. It originally was attached to last year's National Defense Authorization Act, and Representative Hill had it removed from that because he said the House wanted to have its say on the housing bill. And this, with the community banks, the community banking provision, this is the House's role. So what has to happen is, there's going to be a conference to try and marry the two bills up. I think for the most part, the Senate's not going to have too many issues with the community banking provisions that are in here. But what that does is it gives Senator Warren the avenue to try and add to this bill some consumer protection hot button issues for her that's not in Representative Hill's version. So this could be a negotiating piece. And when you look at the legislative cycle, the window for real law change, really is from now until July or August, after which nothing is going to get done because everyone's going to be focused on the midterm elections. So it's a really short window, and I think there could be some significant battles on what may get amended to this bill on the consumer protection front.
Yeah. Got a poll question as we switch to the macro. What is your outlook for the U.S. economy through the end of 2026? Basically this year, are we seeing a downturn? Is it flat? Significant growth? Modest growth? Let's see how bullish or bearish our crowd is. Paul, you pretend to be an economist. What's your outlook?
I took 3 economics courses at Illinois, so I am an expert. I think 2026 is going to be a little up, a little down. Probably more volatile than we've experienced. I just think this K economy, it just concerns me because if anything goes wrong, interest rates go up, the stock market goes down, all of a sudden people who think they're rich, all of a sudden realize maybe they're not as rich as they were and they stop spending. And then all of a sudden you've got a recession. Yeah. And it just seems to me that there's just something bubbling under the ground. I can't put my finger on it, but it's just makes me nervous. And, this idea that, if Kevin Warsh does a good job, interest rates probably go up. If he does a bad job, interest rates go down. It's kind of like he's kind of in a no-win situation.
Yeah.
And the housing crisis, I mean, I don't know how everybody's for cheaper housing, except when it comes to your house, if you're ever going to sell it.
Yeah. Let's close the poll question, but the consensus pretty overwhelmingly is a May year, not, I think 59% said modest growth, 34% said flat. Only one vote for a downturn or a recession. 2 people said significant growth. So the consensus is somewhat in the middle. Michael, Josh, any thoughts on that?
I mean, for all the reasons that Paul said, I would tend to agree. There's more probability for volatility. There are some wild cards. Does the Supreme Court nullify the whole tariff issue? That could be a wild swing in one way or the other, depending on how ugly the fight with the EU gets with the administration in terms of walking away from more and more American products. You have the agriculture situation with Eurasia. So there's a lot of sort of macro issues that don't lean toward the positive side of the distribution curve. There's also nothing that I'm seeing that would indicate some kind of a risk of a large downturn or recession that would sort of hit overnight. But again, you don't see those until you see those, and then they show up. So I would tend to agree with. I mean, I was a flat vote if you're asking my vote here, but I think it's between flat and modest growth.
Yeah. Well, speaking of interest rates, I mean, in my view, the biggest uncertainty in the economy and on our deficits is what the Supreme Court does with the tariffs, right? I mean, if the Supreme Court invalidates the tariffs and everyone's got to send their money back, well, obviously that's a windfall for those companies, many of which may have thought this would happen all along, but it also could send interest rates much higher. So, Michael, you're a man in DC. I know you got some insight in the Supreme Court. How do you see this playing out?
I don't think anyone has insights into how this is going. You could tell from the questions during the oral argument that there is concern, or there's concern that whether there was legal authority for the manner in which the tariffs were imposed. The questions seem to signal that. So, there is the possibility that the tariffs are invalidated, and then, what's the waterfall effect of that? Certainly there could be refunds, and what does that do? Those are the questions that we're pondering now. But short of that, could the courts could keep it in place? The courts could punt and go back and and leave it. I guess any ruling that the courts come up with, and Congress would then have an opportunity to react. But as we had talked about a few minutes ago, the window for Congress to act is really short. So depending on when this decision comes out, will let us know whether or not Congress will have enough time to react and put, take some kind of, not countermeasure, but some action in response to what the courts have decided.
So the Supreme Court could invalidate them, and then Congress could do a special session and vote them into law, or at least some of the tariffs.
Well, I think anyone would be foolish to try and guess what Congress would do at any point in time, but certainly they would have the ability to, create laws that may give more certainty to the tariff powers the president may have, or impose standards of their own on a going forward basis. So. Certainly Congress could do that. Again, the window for that action to happen is very tight. So I'm not sure how successful that, so that kind of effort may be.
But John, the item that not being discussed, which I find disheartening, is, even this discussion is whether there should or shouldn't be tariffs, or how this should be approved or not. Why is there not more of a discussion about the use of the tariff dollars? Like, if those tariff dollars came in and went to pay down debt, it'd be a very different view. Then, okay, fine. So if you had to return it, all you're doing is just going back to the debt level we had before. But why isn't Congress or even the national discussion being, okay, tariff or no tariff, why don't we have rules around what we're using those collections for?
Yeah.
Well, I think one of the big issues is we've already got a $3.1 trillion deficit. which we're not really talking about. It's 100% of GDP.
Right.
So, anything that happens could be devastating, just because of that fact. I think actually getting rid of the tariffs could be the best thing for Trump, indirectly. And that is, you've got all these companies like Caterpillar, Deere, who sell worldwide, who are watching their sales become hugely volatile, or they push all of their, productivity, or the building of all these, tractors and other stuff to somewhere outside the United States. So, you get a lot of this just stuff that screws up the economy for no good reason. And people can start importing stuff without penalties. They can sell it cheaper. Inflation can go down. You can see a lot of benefits that could happen in a pretty quick period of time.
Well, let's talk about this K-shaped economy. And I think we crossed the threshold last year where the top 10% are now responsible for more than half of consumer spending. Obviously, that creates a concentration risk, right? Where if you have, like what's happening in Bitcoin, a 35% drop, doesn't that eat into the wealth effect? And if the people with assets see those assets going down in value, couldn't they just significantly reduce their spending?
They could. I mean, I don't know. I don't look at Bitcoin as the driver.
No, I meant other assets.
That's held by a very specific subset.
I'm just saying the concentration risk with half of consumer spending being with 10% does create a concentration, right?
Yep.
Yeah. I'm less worried about the top 10%. I mean, I think those people are sort of independently wealthy in their own right. I mean, you got to be making more than $300,000 a year. You're probably doing pretty well. I think that next 15%, next 20%, who are the guys who've levered up on their homes, own a fancy car that they can't, that they pay for monthly, maybe have a little bit more volatile income. Those are the guys that concern me. I mean, it's been interesting, like, looking at a situation here in Chicago, how poorly the commercial real estate market's been doing. Something that's been doing great for the last, 5 or 10 years, all of a sudden now is struggling because of higher interest rates. Yeah. So a lot of those guys who would be considered wealthy maybe are a lot less liquid than they were, 2 years ago, 3 years ago.
I think those, Paul, are the people that we saw on the opening chart that John had put up with the rising delinquencies, with the automobile and credit card delinquencies. That's the part of the part of the economy that's really suffering right now.
Yeah, I guess, John, that's the interesting question, which, we don't have a ton of time, is, yes, we're saying consumer spending, but if you're talking the top 10%, what is the spending on? It's not washers and dryers. It's not, right? Yeah. Like, that's not, it's what? It's high-end watches or Ferraris or travel or, it's very limited things that if that all stopped and no more Ferraris are being bought, is that going to really affect the economy? No. So I don't know. I'm more to where Paul is. It's that next tier below.
Yeah.
Right.
Well, a good example is if you look at hotels, for example, you compare, RevPAR growth, which is basically revenue per room per day. The luxury hotels have grown by like $100 in the last 10 years. And the economy hotels have grown by like $10. So you're definitely seeing that sort of play out in industries like hospitality. Paul, I know one of your pet issues is agricultural. You're worried about agriculture. Yeah. Why should we be concerned?
Well, I think the big issue is, they, ever since Russia invaded Ukraine, they haven't been making any money in at least soybeans and corn. So in 2024, a small portion of what they harvested went in the bin because they couldn't sell it. 2025, I think almost all of it's going to be in the bin. And this year they're going to plant, starting next month, April. And right now the cost to put that seed in the ground is more than what it's worth on the takeout. So there's no hedge. It's a complete bet. Yeah. And right now, at least according to the University of Illinois Agriculture Department, the average farmer in Illinois is going to lose $150 an acre. The average farmer does about 3,000 acres. So that, you can do the math on what that means. probably out of that 3,000 acres, they're probably renting 2,000. So now they're going to have to go back and renegotiate that to a lower level. So, you know, whoever owns the land is now not going to get the returns out of it. The concern I have, you know, there's a lot of guys who have had their loans renewed, you know, on the line of credit side to put, you know, stuff in the ground, and that's covered by the land value that they have. And right now you're starting to see those two valuations, the loan valuation and where the land is valued at, starting to come pretty close to equal. Not there yet, but, and, you know, as I said, it was anecdotal, but there was a piece of land in West Central Illinois that's supposed to sell for $17,500 that sold for $13,000, you know, a couple of months ago. That's the first land I've heard of in 10 years, maybe longer, that didn't sell for what the asking price was.
Yeah. Yeah.
So there's a lot of leverage there that's a bit underneath the radar.
Yep. My last question before Bob comes on. A lot of chatter about the dollar lately. Do you have thoughts on where the dollar's going? Seems like the administration's pretty content to let the dollar weaken.
They seem to be arguing two sides to it, right? They seem to be content to it weaken, but then, you know, they want stablecoin and all these issues to be driving currency back to the U.S., dollars back to the U.S., right? Which would be for a strengthening. So it's, I don't know if there's really a cohesive thought in D.C. That's policy, cross policy.
Yeah.
I think it's also early, you know, because all of these guys, you know, like the European countries, China, all are big holders of U.S. treasuries. And I think they're all sort of thinking, hey, what if we sold $10 billion tomorrow? What would happen? And I don't think we're in a position really to understand what would happen and how big an impact it would be.
Yeah. Yeah. Bob, you've been listening to us talk.
What a great conversation, gentlemen. I have an interesting question. I'm curious, for some bizarre reason, I've been looking at new bank charters. And does the same M&A turnaround in terms of decreasing time also apply for investors who want to start a new bank?
No.
It's not quite as dramatic. It's not
All
quite
right,
as
let me go to my
dramatic of
next
a
question.
change.
Thank you.
Yeah.
I think there might be at least a week or 10 days less.
Okay. Follow-up question. What is the minimum viable asset size a smaller bank needs to be, quote, viable? Have any of you guys thought about that?
All the time. But there's no unified answer though, Bob.
That's why I'm asking.
If you're looking,
I don't know.
If you're looking in a very rural market, it can be much,
Sure.
much smaller, right? So
Okay.
I'd say on average, at least 100 to 200 million if you're in a very rural market, probably
Okay.
500 million if you're in a secondary market, and at least $1 billion if you're in a metropolitan market. If I just broad strokes, what do you guys think?
That sounds about right to me. Yeah.
I'd be pretty close. Although, Josh, you know, there's like 5 banks in Illinois that have 5 employees or less. So you can get pretty efficient at that level.
Yeah.
Right.
I know one that's not really efficient at that level, so no guarantee.
Bank failures. John, Annie, you want to put up that first slide in terms of the delinquencies? I mean, there's some shocking numbers on that. See, we had 2 last year, and there's 1 so far this year. What's your prediction in terms of these really small banks and how they're going to fare in 2026?
Yeah, I mean, I have some firsthand knowledge on bank failures. We did do some work on the one that recently failed, representing one of the unsuccessful buyers. But you know, I did have a few conversations with our friends at the FDIC, and they do think it'll be busier this year. So there will be more.
John, is that because of fraud or because of the model doesn't work?
Could be a variety of things.
Fair enough.
Usually asset quality and fraud are two causes. I mean, the last 2 in Chicago, one was fraud, one was asset quality.
Right.
I don't think the liquidity is really bringing down any banks as of late. No.
No, I mean, Bob, I mean, a couple answers on that. One, to put things in context, that big hump over 2010, the highest 1-year default rate, meaning banks that failed as a percent of the number of banks, was 2%.
Yeah.
That's the highest. So
Right.
it's not a very big number, even in the worst of times. You know, compared to a high yield bond default rate could be 15% in a bad year.
Yeah.
The second thing is going into that cycle of 2010, banks had significantly less capital than they do today, had significantly lower loan loss reserves than they had today. So
Interesting.
I think it'll be quite muted
Okay.
for the next year or two, three.
I
Last
agree with
question.
Josh. You know, the Metcalf situation was completely unusual, and you know, you could see that again, but it's not like there's going to be 100 more like it, you know, in any way, shape, or form. You know, I think there's going to be some ag bank failures just
Yeah.
because of how hard the economy is going to get hit there if it continues the way it is. But I don't think it's going to be any big number. I mean, it's not quite like, you know, when I was 25 years old and every Friday night I drove the interstate to help the FDIC close a bank when I was with the Federal Reserve.
Right.
I mean, that was fun times.
Great. Thank you for that. Great panel, John. What's the next topic?
I think we need to do another commercial real estate one. I think that's
Yeah.
probably overdue. We'll
Yeah,
bring
I
our
think
commercial
that'd be
real
good.
estate group back. Well, thanks again for hosting, Bob. You want to close it?
Sure. This is awesome. Thank you all, gentlemen. I truly enjoy these conversations. I enjoy the higher level analysis of what's going on. You guys know what you're doing, so I appreciate you taking time to share it with our audience. And this concludes the webinar. Thank you very much, John.
You got it.
Thank you.
Take care.